Let's move to another core idea in insurance that often confuses students: perils and hazards. These two words are closely connected, but they do not mean the same thing, and understanding the difference is essential. Let's start with the big picture. In insurance, a loss does not just happen randomly. A loss is caused by something specific, and the severity of that loss is often influenced by surrounding conditions. This is where perils and hazards come in. A peril is the actual event that causes the loss. Think of it as the trigger. It is the moment when damage, injury, or financial loss occurs. Fire, theft, collision, explosion, and negligence are all examples of perils. Insurance policies are written to protect against losses caused by specific perils. For example, if a fire starts in a kitchen and spreads through a house, the fire itself is the peril. If a car window is smashed during a riot, the riot is the peril. If someone slips, falls, and gets injured because reasonable care was not taken, negligence is the peril. The peril is always the event that directly produces the loss. Now here is the important shift. A hazard does not cause the loss by itself. A hazard is a condition that either makes a peril more likely to happen or makes the loss worse when it does happen. Hazards sit in the background. They increase risk even if nothing bad has happened yet. Hazards are usually grouped into different types, starting with physical hazard. A physical hazard is a visible or measurable condition related to property, equipment, or the environment. These are things an inspector might notice during a site visit. Slippery floors, loose tiles, exposed electrical wiring, cluttered stairwells, poor maintenance, or outdated systems are all physical hazards. On their own, they are not losses. But they increase the chance that a peril like fire, injury, or equipment failure will occur, or they can make the damage much more severe. Many physical hazards can be reduced or removed entirely through proper maintenance, repairs, and safety measures. This is why insurers care so much about inspections and risk prevention. Now let's talk about hazards related to people, not buildings. A moral hazard relates to dishonesty or intentional behavior. It exists when a person may deliberately cause a loss or exaggerate a claim for financial gain. Fraud is the clearest example. If someone lies about how an accident happened, inflates damages, or intentionally causes a loss to collect insurance money, that behavior represents moral hazard. Moral hazard is difficult to detect and extremely difficult to eliminate because it is tied to human intent. Closely related, but slightly different, is moral hazard. Moral hazard refers to carelessness or a poor attitude toward risk. This happens when someone becomes less cautious because they know they are insured. For example, failing to maintain property, ignoring safety concerns, or thinking, "Why worry, it's insured anyway." Unlike moral hazard, there may be no intent to commit fraud, but the lack of concern increases the chance or severity of loss. Insurers pay close attention to moral hazard and morale hazard, especially during underwriting. Underwriters look for warning signs such as poor maintenance, careless attitudes, financial stress, or unusual claim patterns. These signals do not automatically mean a hazard exists, but they raise questions that must be explored. So let's bring this together clearly. A peril is the event that causes the loss. A hazard is a condition that increases the likelihood of that event or makes the damage worse. Physical hazard relates to property and conditions. Moral hazard relates to dishonesty. Morale hazard relates to carelessness and attitude. Once you separate these ideas in your mind, insurance decisions start to make much more sense. Policies respond to perils, while underwriting focuses heavily on identifying and managing hazards. That distinction sits at the heart of how insurance evaluates risk and controls losses.